This is a brief overview of subsequent measurement of debt investments across all three categories. We're just talking about the debt investments here as we think about the subsequent measurement issues that arise after purchasing a bond. Remember, there are three categories for the debt investments: held to maturity, available for sale, and trading securities. Well, the bond itself doesn't know what category it is in, so it is going to behave the same way regardless. And we learned in Chapter 14 that bonds pay interest. Now that we are the investors of the bonds, this means that we will receive interest payments periodically. On the investment side, we have to prepare an amortization table, just like we did in Chapter 14. The only difference is that now we are using it to come up with an entry for interest revenue and cash received, rather than for interest expense and cash paid out. There will still be discount or premium amortization that has to balance the interest entries. You already know how to do this, but you might want to just give it a quick revisit if it feels shaky. So the interest happens for all three categories. And for your held to maturity bonds, this is the only regular subsequent measurement thing you have to deal with. So let's turn to the available for sale category. Remember here, management may or may not hold on to the bonds. GAAP requires that available for sale investments be reported at fair value. Practically, this means that in addition to recording interest revenue and maintaining the amortized cost of the bond investment, we will do an adjusting entry to bring the amortized cost to fair value each time we prepare financial statements. This happens through a permanent account called the Fair Value Adjustment Account. It's a valuation account, which means that it can have a debit or a credit balance, but it is attached, if you will, to the investment account. So that on the reported balance sheet, you only see a combination of the bond investment account, plus or minus any premium or discount account, plus or minus the fair value adjustment account, with the reported amount being equal to the investment's fair value. The fair value adjustment account is permanent, which means that its balance will carry over from one year to the next. So after the first time you use it, you will always be making your adjusting entry to fix the fair value adjustment account balance so that the balance in the account equals the difference between the fair value and the amortized cost of the bond. The other side of the fair value adjustment entry is an account called unrealized gains and losses on available for sale securities -OCI. This should look vaguely familiar because we used a very similar account in Chapter 14 when we talked about the fair value option on debt. The -OCI tells you that this particular account gets reported on the Statement of Comprehensive Income. Your project likely includes this account, and now you know why. The third category of debt investments is the trading securities. Remember, this is the category used if management intends to sell the bond before it matures. But in the meantime, the amortization schedule has to be maintained and interest revenue is recorded. GAAP requires that trading securities also be reported at fair value using a similar fair value adjustment account for trading securities. The reporting is just like what I described for available for sale bonds, with one big difference. The difference is that the unrealized gains or losses for trading securities go through net income instead of through OCI. So these unrealized gains and losses would be reported on the income statement. There you have it, the basics on subsequent measurement for the debt securities. There are a few more issues that we'll talk about in other overviews.